third day, the second session, we would like to commence. And we have here with us CA Pradeep ji, and I would like to welcome him with the help of one of our chartered accountant member, Miss Nandana Madam. Please escort him with a floral bouquet as a token of advance and appreciation. We welcome Ms. Pradeep ji. That is the second session of the third day, and also I request her to please present the memento. Sir, please accept the memento. Thank you very much, sir. On behalf of our Bangalore branch of SARC of ICI, I once again take as an opportunity to introduce Mr. Pradeep ji, as he is a partner in the Global Transfer Pricing Services of BSR and Company LLP, and he is based out of Bangalore. He has 16 years of extensive experience in the tax consulting. He has previously worked with EY, PwC over the past 16 years. Mr. Pradeep ji has focused on the international tax transfer pricing as his areas of specialization. He is a chartered accountant and holds a bachelor's degree in commerce also. He consults with the clients in the eventuality of their transfer pricing models and providing the transfer pricing plans, compliances, and the negotiations on so many aspects throughout India. He has experience in handling with transfer pricing and the international tax issues faced by the clients in the industries such as manufacturing, electronics, and heavy engineering, automotives, chemicals, and as well as wind energy, ITBS. He is in the expert committee of the direct taxes of the Madras Chambers of Commerce and Industry. He has worked with the industry's leaders in their efforts to lobby with the government on the industry issues and concerns. He has contributed to the revised guidance note on the transfer pricing brought out by the ICI. He has also contributed articles to the various national and international publications, frequent speaker and as well as the presented various forms in India. With this, I request Pradeep ji to please take our next concluding session. Please. Thank you.
So, third day, I think most of them have exhausted into these sessions, but I admire the spirit of all of you who are present here, and on a weekend it takes an effort to come and listen to topics as what we have been discussing in the morning and now. So welcome you all, and I will probably try and understand from those present as to two topics that we are going to deal with. One is what we call as thin capitalization, and the other is on the secondary adjustment. So probably that's where I have structured that probably I will go with the simpler topic first, as in which is more easily to kind of you can comprehend and relate, and then probably move to secondary adjustments. So thin capitalization. Can anyone just give a layman's interpretation of what does it mean, thin capitalization? Yes, sir, you can make an attempt.
Assets are more, capital is very less.
Yes. So what we have been seeing is when you look at companies, the intent of the government and as well as the industry is to kind of have stability and want them to remain invested for the long term. So if they bring it by way of equity, there is an additional stake, as in they will come, they will invest, they will remain invested, become profitable, and they are there to stay for long term. And they are not into it looking at short-term return or trying to pull out whatever they are investing as soon as earlier. So across the globe, what the observation has been that while it is when you bring in investments, there is always a mix between an equity component and the debt component. Again, for anybody as a starter to get any form of debt locally also becomes difficult without a backing from their owners. The owners can be anywhere across the globe, but given based on their comfort, based on their guarantees, the local bank here can give the loan, and that's how they will be able to get a loan. When they themselves are cash crunch and the group, at an overall group, they are not having adequate funds to put in as capital, probably they will show their future business potential and try to kind of get this funding and assistance from third parties, or they themselves can give as a loan also. So more importantly, what's happening, many of the many multinationals who operate over a period of time have seen that anyway in any market to go, grow, build and become profitable takes as much more time, either to reap the return by way of dividends or any other form. So debt becomes an easier form that you can get repaid back as by way of interest, irrespective of whether your own subsidiary is in a profit or a loss situation, you will get a return by way of interest. And as long as that interest that you get back satisfies the transfer pricing requirement of arm's length, then you don't really have an issue. Separately, you will have other transactions. You will have an interest transaction. For what you have invested, you will get back interest, which you will benchmark. You will say that it meets the arm's length, and you take it out. But even those levels of interest, if it is pulled out when the company is bleeding and in a loss situation, there is a loss to the exchequer to that extent that you are incurring an expenditure that is tax deductible. But then there doesn't seem to be an intent to make profits. Some are genuinely having challenge of gaining the market. There will be so many hurdles when you start the business, especially those businesses which require significant capital. You need to kind of invest heavily, get the machines. There will be a lot of non-cash cost by way of depreciation and amortization and all that. That by itself will kind of dent the profits. So looking at profitability and measuring everything probably may not be the right approach, but then year on year, say even after 10 years you continue to make losses, then there is something alarming as to, okay, there is heavy debt, interest payouts are there are various other payouts, there are a lot of transactions with the group entities, but then this entity is not making profitable. If you look at other players who have started then and other competitors, they are making profits. So that is where I think this whole concept of thin capitalization, we were saying that it will come, it is already there, and a lot of discussions in the OECD also. So basically what happened to the OECD countries, while India is an observing member and not part of the OECD directly by itself, and again the G20 nations, all of them came together and came up with a BEPS action plan, base erosion and profit shifting. So as part of that, one of the action plan was of action 4, where they were looking into these interest and financial instruments which are used to kind of fund and then look at where is the base erosion that happens. So to curb the base erosion and to kind of curb profit shifting, more so profit shifting in case of interest. So these norms have been brought in. So we'll go lucidly slide by slide, and I have got some illustrations. So this is to set the context. So the context we are clear. If you have any upfront questions, please feel free. Any questions for starters? No questions? Yes, please.
But when the subsidiary pays interest, anyways it's taxable to the holding in India, right?
Yeah.
So there's no basically tax loss which is happening to the exchequer because it's anyways taxable for the holding.
No, I agree, but then you are allowing a 30% reduction on the interest and you are withholding only 10%. So there is a 20% arbitrage of actually that you lose out. So when you disallow it, when you let them to carry forward into the subsequent years, at least that year, you would all stand to lose. The TDS element of it when the interest payout happens is only marginal as compared to allowing the entire interest as a deductible expense in profits and gains under business or profession. Okay. So that's where, yes, there is a marginal element of withholding tax, which again, because that income is taxable in India for them, that is there. But then you lose out more, so it's like 1/3 to 2/3. You understand? Good. So we set the context, we said where is this issue coming from, it's about your composition of debt equity and what is the right mix. So can someone say or determine as they start as to what could be the right mix? There are various parameters that will come into play. Again, the interest rates in the respective jurisdictions, the country from where they are lending, the kind of return they get there itself in their market vis-a-vis the return that is expected in the India, and their own internal reserves and surplus what they carry. So lot of factors depend upon how the multinational group is structured as to determine. It will not be only tax consideration, whether to take a loan and kind of pay out the interest, or whether to fund it by equity, and also about the stability of the jurisdiction, about why you remain as much more invested, whether there is a need to heavily capitalize. Lot of decisions can come into play. So naturally, from a tax authority or a regulator, or for that matter the government can't go step itself into the shoes of the businessman to say how he has to run his business. It all depends upon his accessibility to the funds, the way that he can access, and at what cost it comes, and at what phase of business he is in, whether he is starting, whether he is putting up a new plant, or whether he is setting up some venture in another country. So all of dynamics. So really it is difficult to regulate that this is how you should go. But then again, given the background and what I explained to you, there has to be something to control things. So that's when we have certain ratios to kind of help and control this, as to what should be the rightful the composition of the debt and equity. When we went back to BEPS action plan, the thin capitalization under what is brought into the Indian regulations follows almost the same pattern, but then we'll just see what methods are there to bring in under the statute to say that up to this you can go, then beyond this, as in, so we'll just look into that. Okay. This is called fixed ratio rule. So in a fixed ratio rule, what would happen is you would measure the earnings before interest, tax, depreciation and amortization of the entity. And you would have a fixed ratio which can be like 10%, 20%, 30%. So up to 30% of the profits can be paid out as interest. Okay. So that's a fixed ratio rule without any, so irrespective of whether it is at arm's length or not, the first thing that we touched upon, as long as you are at arm's length, then you can defend what you are paying out as interest. So the arm's length rate says 5% to pay back to say US or Europe, which is a nominal expected return in those countries, unlike a higher return here. This ratio will come in to say that the surplus over and above 30% of profit, you would not be eligible to get a disallowance in the year in which you pay. But it's not like it is all is lost, where it is more looking into the future, that there is plan to kind of capture the market, achieve the volume, become profitable, then you can carry it forward. Like your depreciation and losses, you can carry it forward over the next 8 years. So that's kind of a thing that is there when it comes to fixed ratio, to curb it to a particular percentage of profits and carry it forward. So this simple, becomes easy to administer, becomes easy to evaluate, but then yes, it comes with its own complications of what should be the EBITDA, how it has to be computed, whether it is as per tax or as per the standalone financials. So all those things are there, we'll deal with it. But then just for an understanding, fixed ratio rule is something, percentage of profit up to which you will be allowed for your interest payouts, beyond which it will get carried forward and disallowed in that year. You can carry forward up to certain number of years. In the Indian context, the regulations provide for 8 years. Group ratio rule. This is more recommended by the BEPS action plan, wherein it says you need to necessarily, as I explained earlier, it is more the group structure, the multinational, the way how they operate in various countries, availability of funds, how much is the group leverage. If they themselves are in huge debts, then what is it that they would want to kind of invest and remain invested and wait for returns after 5 years, 10 years? Probably it is easy to get a loan there and funds are available, but the return is not as much, so they themselves can lend to India saying probably I can get a better return, if not immediately, but at least the second year you become profitable, the third year your return of interest is higher than what you see probably of achieving profits, arriving at the reserves, and from the reserves pay out certain percentages, dividends and all that. So please consider the group ratio. So you will have so determine the group's net third party interest to EBITDA. So the group by themselves, obviously they remove that and look at how much they are leveraged with the third parties, with other bankers, and see what is their exposure. Look at what is the group ratio. Compare the fixed ratio with the group ratio. So fixed ratio is 30, group ratio is 40. So even if the standalone entities of this entity which has thin capitalization in its jurisdiction, they are leveraged to the extent their interest is say 35%. Fixed ratio says 30%, but group ratio is 40%. So allow 35% because it is within the group ratio. The group ratio becomes the upper limit because I can't get more leverage than my group itself. That's the logic to it. So this was recommended, but as we are all aware, in the Indian context, everything comes with more kind of a lesser loophole or lesser leeway. So only what we now have for as a ratio is the fixed ratio of 30%. Okay, so let's look at the Indian context. Applicability. To whom it applies? It applies to Indian company or PE of a foreign company, as in branch and such operations. Right? What is it that is calculated as to kind of as charged to tax, as charged to the P&L? What is interest? Interest or similar consideration paid in respect of any debt from AEs or debts guaranteed by AEs. So we are always one step more. Okay, ratio 30%. Then it's not alone AE, but it is also, even if you take from third party lenders overseas, where it is based on some guarantee given by the group, that will also take the character of related party funding. It's like the deemed international transaction. Even if the third party vendor is there, based on blue contract we are entering into, we report it saying deemed international transaction, like that. What is disallowed? More than 1 crore. 1 crore has remained as a consistent threshold in the Indian context. Even for you to maintain documentation, 1 crore has been the threshold. So that continues. Deductible in computing business income for debt issued by non-resident AE. So please bear in mind that this interest payout, if it has nothing to do with the group or backed by the group, it is all allowed irrespective of ratios and threshold. So the threshold ratio is brought in to kind of put a check on the AE related interest, as in the related party payouts. So deductible in computing business income for a debt issued by a non-resident. Exclusions, banking and insurance companies are excluded. So because their business itself is into lending. Meaning of excess interest. So we'll look into the calculations and that will be more illustrative and explainable. But to quantify something as excess. So what is excess? So excess. So when we say what needs to be disallowed, so we look at total interest paid or payable in excess of 30% of EBITDA, that is interest paid or payable to AE, whichever is lower. So when we look into the illustration, which I will explain going forward, this will come out clear. What is in excess of 30% is on one hand, and how much you pay as interest to the group is on the other hand. Lower between the two will be pulled out as excess interest. The quantum, not the per se the quantum, the numbers numerically which is lower between the two, to that extent it is considered as excess interest, disallowed in that year and allowed to be carried forward for 8 years from that year on. So guarantee, lender not associated, we'll get into that. So carry forward of amortized interest for 8 assessment years. So I think this is fairly simple, straight, clear. Now what is a debt instrument? What all can take the character of debt instruments? That has also been defined. Loan, financial instrument, finance lease, financial derivatives. What can be included in interest on similar considerations? So there is form of debt. It can be debenture, it can be preference share, it can be. So what is it that is defined? So it is loan. Preference share is a financial instrument, finance lease, financial derivatives. So it becomes important to carve out as to what is debt, interest bearing debt. What is debt? And then what is it? It is not restricted only to interest, because if you would have paid attention when we said that they give guarantee, it's a service. Giving guarantee, I am not giving funding, I am giving guarantee for someone to lend loan. So I will be receiving a fees. So service fees. So within the nomenclature of interest or similar consideration, service fees, other finance charges, discounts, lease payments all come into play. So charges deductible in the computation of income chargeable under the head profits and gains of business or profession. So what gets qualified as interest and relatable charges deductible under profits and gains from business or profession is what will get measured or compared with the 30% of the EBITDA. Clear? When we go to example, you'll be able to really appreciate and understand. So let's jump into an example, and probably I will try to understand from you as to how you kind of relate to this. Is this visible? So probably, I mean, I'm not sure if my earlier handout is given or earlier handout is. This is a little different. Sorry for that. Yesterday night I made this. You will receive this one because I mean, interestingly, our institute. The implementation guidelines on tax audit report just came 2 days back, and a lot of it is dealt in that, and so probably I have kind of refurbished this to that extent. So just if you were to look at this on the slide, so I mean I can read it out, but broadly if you can just pick out those which will not take the character of interest or financial charge or anything. There are 10 items. So first is, and think about debt is given, okay, debt or support or some guarantee and all those things is given. So look into the charge for it, either interest or fees. So from that perspective, which of these 10 will partake the character, the payouts or the expense or the return on these 10 items, which of it will not fall within interest? If you can just pick, I mean, I hope it's visible. If it's not, I would request probably for some of you to kind of come to the front if you don't mind. Because if I have to read all of this, it could take more time than you just scanning through. Even if you name 1, 2, I'm okay, I mean, I can.
So the 10th one is not.
A company declared, yes, it's like whether dividend is an international transaction at all itself. I mean, so it is an. What is that? We say it is apportionment of profit. It's not kind of not 1 and 2 bear interest. Yes. 10 does not. 3 yes. 4 yes. I think we are almost covering. Some try from end, some try from top.
So I don't know. 7th one, I think, is not partake. 5 yes.
5 yes. Okay.
6 also yes.
5 you are saying yes. Okay. Credit short term credit 6 you are saying yes. Okay. So we have a doubt on 7.
7 is a doubt, yeah.
7 is a doubt.
Because
Okay.
other finance charges and
Yeah, 6 is a yes. We have accepted.
operating is no.
Right. So our doubt gets clarified to the extent that it is for usage of the equipment, and it is not that I own it. So it is more for the usage I pay the fees, and it is an operating lease. So when we go back to the definition here, we said financial lease, financial lease, the third item. So operating lease does not.
ECB loan also covered under.
Yes, ECB loan will squarely get covered. Yes. No, good point. Yes, it gets covered. So any kind of performance guarantee and those kind of things wherein I assure the quality, I vouch for that, and for which I receive some fees, or any kind of referral of customers. So all these are outside. They are not financing or funding transactions. And so to kind of close this example, 1 to 6 qualify. Any payout for this consideration of financial support will be in the nature of interest or similar expenditure. 7, 8, 9, 10 will not qualify. So this is one of the examples given in the action plan 4, and it is listed by the OECD manual. So 1 to 6 is 7 to 10 no.
Yes.
No? This is again, it is widgets means it's the product, so it's a performance guarantee. Performance guarantee doesn't qualify.
What is widgets? He said.
It's a product. I think it's they have said 10 widgets. I think it's a product. as in commitment for delivery of so many number of so much volume of product. So that's my inference from that. Because it is performance guarantee, it is to do with so much volumes will be produced.
So,
Yeah.
suppose the holding company gives loan for construction of some machinery and the interest is capitalized. Will it come under this green cap?
Yeah, that is a grey area. So if it is capitalized, it doesn't hit the profit and gain from business or profession, it gets capitalized. Yeah, to answer to your point,
But subsequently as a depreciation it will still come in.
no, I think the year in which the charge happens, it takes a different character. It doesn't come into as interest. So once you capitalize and once you start utilizing and amortizing it, it doesn't take the character of interest.
So it won't be covered.
It won't be covered. Yeah. So yes. So now let's differentiate between, as in the way that we have seen as to how different in the context of India to what was recommended by the OECD under the BEPS action plan. And as we discussed earlier, in the Indian context, it is more rigid. It is very important, given that all of us now, when we do the tax audit report and issue 3CDs, have to be aware of this particular clause as to what to report and what to sign off. And already there's this kicked in now, as of 20th August. It becomes important to pay heed to these provisions as to how we need to interpret. So change in the tax audit report form 3CD clause 30B. Okay, so this is available as of yesterday. I got a message saying it's uploaded in the institute's website and we have a copy of it. But while as a part of my material, I will also share that. But what I managed to do is I got the extracts of it, and in this context, let us dwell some time so that we will get more clarity on what to report. And sorry that these are not there in your slide now, but I hope you can see this from the screen. And I am consciously going slow on these because it's more conceptual clarity that we need. So the clause 30B(a), whether assessee has incurred expenditure during the previous year by way of interest or similar nature exceeding 1 crore rupees as referred to in subsection 1 of section 94B. Okay, if yes, please furnish the following details. Amount of expenditure by way of interest or similar nature incurred. So we are clear what to report there. Now after those examples, we are. So debt is widely, so the guidance note on implementation guide, page 27, the term debt, so here expenditure by way of interest or similar nature. So first it goes on to define debt. Okay, debt is what we discussed. Debt is defined as mean loan, debt is defined to mean loan, financial instrument, finance lease, financial derivatives or any arrangement that gives rise to interest, discount of finance, expenditure of similar nature. For the purpose of this section would therefore include discount or premium on securities, finance cost, component of lease rentals in respect of finance lease or other finance charges. So this is there in the institute guidance note, and it is, I mean actually it's more a replica from the section itself. And an interesting observation now which you should give heed to. Therefore, any interest disallowable under section 14A under the proviso to section 36(1)(3) under section 40A1 or section 40A2 should not be considered as interest for the purpose of section 94B. Similarly, interest disallowed on account of transfer pricing adjustment under 92 should not be considered. So what all gets disallowed by themselves, like for not withholding, if they get disallowed under 40A1, that goes out. There is no question of again disallowing that, because by fact of not withholding, it is disqualified in the first place itself under a different proviso, and it doesn't partake the form of income under profits and gains from business or profession. Okay, I mean not income, I mean as an expense. So we keep that out. This is a fundamental difference, and I mean there are some nuances. If we pay heed, the next time we won't. I mean when we do this for the first year, the first time when our clients' financials and this thing we observe, we'll have clarity. So it's worthwhile to kind of go through this. It's page 20 to 30 of the guide. Then okay, earnings before. So fundamentally, this 1 crore. Any interpretation how this 1 crore, should we look at it cumulatively 1 crore interest, or should we look at each lender, because there can be 2-3 entities which might have given loan. So how do we, what's the best way to look at it? Cumulative. So cumulatively if they exceed, even if the other entity gives, we pay out an interest of 50 lakhs or less than that, we will conservatively disclose. That's what you are saying.
But it's a loan from only A's.
Loan from only A's. So it's better to take that approach, and I think that's what is recommended. But here, I think based on the view taken by the assessee, appropriate disclosure should be made in 3CD. So where if a client comes to you and fights tooth and nail saying that no, I want only this entity to be disclosed and not the other, because only here it is exceeding 1 crore, you can take a call, put an appropriate note and sign off.
I think we should qualify that.
We should
Qualify that.
Should qualify that. Yeah, so going by, I mean, you wouldn't want to have materiality to come into play to decide when fundamentally in principle they breaches the threshold. So yeah, yes. So amount of expenditure by way of interest or similar nature as per one which exceeds 30% of EBITDA. So EBITDA. So it's a good thing. On page 29 here it gives reference to Collins English Dictionary defines EBITDA as the amount of profit that a person or company receives before interest, taxes, depreciation and amortization have been deducted. Section 94B2 uses similar terminology. While computing the EBITDA, the figures as per the final audited standalone accounts of the company should be considered and not the figures as adjusted for the income tax computation after various allowances and disallowances. Clear? Standalone audited financials, what is reflected as net profit before interest, tax, depreciation and amortization. Because when we practically start reporting under each of these clauses, all these doubts can creep in. So it's very good that the institute has come up just in time. I mean, from 20th the requirement came and 26th we have this guideline.
This is the only change in the 3CD tax audit report, sir.
There are other changes as well. There are other changes. Even on the second year adjustment you have, and plus there are a few more. So actually it's a book, it's like just released yesterday, it's just in the website. Yeah. So GST is there, 3280, 43B, there are second year adjustments. So
What is the provision for the loss making companies?
loss making companies, yeah. So let's look into this example actually. So when we look into this example, while it's not loss making, but I think with this example we should be more or less done on this. If you have understood conceptually, then we can probably move further. Yes, loss making, when they are paying to the non-A's interest, it will be a challenge. Yes, up to 30%. 30% is nil. So let's kind of look at it as to determine this excess interest. That becomes very relevant, and you see a combination of debt from associated enterprise, debt from third party, both are interest bearing. So how this plays, you can kind of take note of that. So in the first, so case 1, case 2, okay. It's just that the interest payment to the AE and non-AE is just interposed. So let's take case 1, case 2, year 1 parallel. So AE interest is 20,000, non-AE is 80,000, total interest is 1 lakh. Okay, total interest deduction in both the cases is 1 lakh. Excess of total interest over 30%. Given that EBITDA is same, 30% is 70-70. Actual interest paid to AE, okay, is 20,000, case 1, 80,000, case 2. Disallowance to be carried forward to the next year. So here what becomes is, what is lower of the two? Lower of the two in case 1, 30% of EBITDA versus, I mean as in excess of total interest over 30% of EBITDA. 30% of EBITDA is 30,000 and total interest is 100,000. 70,000 is the excess, so 70,000 on one side and actual interest paid to E, which is 20,000 on other side. Lower of the two, 20,000. Case 1, 20,000 to be carried forward. Case 2, Case 2, the AE interest is as high as 80,000, so 70,000 is to be carried forward. So year 1, case 2, are we understanding the example? So just that last row, numbers 20 and 70,000, take it to year 2 and place those numbers in the line item brought forward from last year. Okay, that becomes your year 2 template. So case 1, 20,000 taken up, case 2, 70,000 taken up. The rest, the flow are same as in the EBITDA and percentages and all that. So as you go down, you compare what 30% of total interest paid over and above, 30% of EBITDA and total interest. So when you look at it, case 1, case 2 of year 2 we are dealing with. So we compare between 30 and 40,000 and 80,000 and 1,50,000 between the two cases. And this allowance to be carried forward for 8 years is lower of these two. So between 30, 40, 30 is lower, between 80 and 150, 80 is lower. So in year 2 what has happened is the AE interest which came as disallowed from the first year got cumulatively looked into as to arrive at what is the interest payout to the AE, actual interest paid to AE including last year's brought forward. So when you included 20 plus 20 became 40 and 80 plus 70 became 150. You understood? That's clear? So,
case 1,
yeah.
disallowed is 70,000. EBITDA 1 lakh, 30% of EBITDA 30,000. 70,000 is disallowed. Excess of total interest over 20% of EBITDA.
70,000.
Only 20,000 carried forward.
In the first case, correct.
50,000.
No. So 20,000 is what you have paid to the AE, no?
AE only disallowed.
AE only disallowance, fundamental. There is no provision to disallow what you pay to the third party. You calculate the excess interest to put a cap to how much paid to the AE can be disallowed, not for non-AE. To remove that confusion only this example was put. Because when both come into play, you say 30% cap, you get confused then what? Should they be in same proportion of debt of AE, non-AE or what? Non-AE not to be touched. Only AE will get disallowed and carried into the subsequent year. To arrive at how much of AE should get disallowed is this excess interest computed in this manner.
But why is this limit of 30% even for non-AE? Non-AE interest can be
30% is my overall. Up to 30.
I take the non-AE and then it's the
No. You take total interest. So beta is after your interest, all interest, total interest. Okay. But then, no. So EBITDA, earnings before interest you calculate. Okay, you understand. So 30% of EBITDA is one number.
Yeah.
Then you separate between AE interest, non-AE interest. Then 30% of EBITDA you arrive at. Then total interest you have one number. Total interest more than 30% you have one number. Okay. One side. The other side is actual interest paid out to AE. You compare between how much is paid more than 30% of beta, total interest, vis-a-vis how much alone to AE. What is the number, numerically which is lower number to that extent. The lower of the two numbers is the number which will be disallowed of the interest paid out to AE. Got it? That's where I know that this confusion will come, because unless you explain it in this way, it will be hard to. So I hope I have succeeded in. Yeah, sorry.
What about the loss making, sir? There will be no
Yeah, loss making. So loss making in a loss making situation. So it will be nil. So lower of the two is nil. So that's why in a third situation. So loss making, I have probably not plotted it, but loss making. So loss making, it is addressed here in the guidance. Okay. In a case the EBITDA is negative, EBITDA is negative, the entire interest and other similar expenditure as per item 1 need to be reported here without any adjustment for the negative figure. The negative figure being taken as nil. Okay?
So the entire interest means a total of AE plus non-AE and all other similar. That's a total interest.
Your non-AE is not question of debate. Even if you have loss, non-AE is allowed. Only for AE it will be a challenge. Clear now? I mean, as in, should we dwell something more? I mean, as in, I have got these illustrations for now to explain. So what would happen? Let us see what would happen in a case where like the Indian AE overseas group provides guarantee and the Indian company receives loan from say any other Indian lender, any other Indian bank. So should these provisions apply? Both are residents. But then yes, it is given as because of the guarantee from
Because guarantee is given by the AE.
because guarantee is given by the AE.
So the AE company have to pay some condition or something.
No. So what we pay to the AE for the guarantee, we don't pay anything because it is like support given by them. Okay, they have a line of credit globally with say Citibank or someone, so they say okay, you don't give me that line in my home country, you give that to India. I have nothing to lose because I don't need funds there, India needs, you give. It doesn't come at a cost for them, hypothetically I am saying. Then what I pay locally to the Citibank or say SBI, whether it is an Indian bank or whether it is a branch of a foreign bank, would these provisions trigger? You are saying yes.
The criteria is guaranteed. It's not who gives the guarantee. Who gives the loan? Criteria is the guarantee. It comes in.
So we convert, I mean, as in we cautiously take the view that while there is no, it is tax neutral, as in the whole of it is going to go and they are going to pay, report it as their income and pay out taxes in India. And there is no profit shifting. Okay, so still would you take this call that because it is not explicitly stated anywhere? While yes, there is the thing that again the whole thing about guarantee, I should tell you the state of it. So what has happened is we should be relevant as on what has happened on this position. Guarantee, are we doing it too much? Are we kind of, because even in the OECD and this one, they have kind of kept it out. Only in the Indian context this has come in. Okay. So fundamentally the question of attributing the loan taken from third party based on guarantee has been filed as a writ petition in the Madras High Court challenging the constitutional validity of it. Okay. So we'll just see in this case, Siemens Gamesa Renewable Power Private Limited. So this is into power, they will year on year need huge funding and then there will be loss and no, it's quite a long time for gestation and turn profitable. So they had funding. So here on Article 14 and Article 19 of the Constitution in terms of discrimination, okay, there is a writ that has been filed in the Madras High Court challenging the provisions of this section as far as the guarantee goes. We don't know the state of it. The Madras High Court has issued a notice to the revenue on this writ. For all that you know, probably going forward this might kind of get quacked. So here if you see, the petitioner contends that the CBDT or revenue has created a distinct and separate class of people without any intelligible differentia through the proviso to section 94B. The includes provision clearly seeks to differentiate similarly placed companies merely on the basis of involvement of an associated enterprise when the our object is to reduce thin capitalization. The classification made on the basis of guarantee given by associated enterprise is arbitrary. Further, if a disallowance is made under the interim provision, then the same would be unreasonable and contrary to the provisions of Article 14 on discrimination and 19 of the Constitution as a similarly placed Indian company with loans more than that of the petitioner company will enjoy a lesser tax burden, and the petitioner, merely because of existence of an associated company outside India, will have to pay huge sum of tax. I think there is definitely a point to this, that it puts a company, especially those like operating in renewable energy power sector, where there is significant focus coming on to invest, that you try to curb their ability to borrow, and then they again are not profitable right from the word go. It will take years, and then you keep disallowing it. So there is a fundamental discrimination that's happening, and then this is being picked up. We'll see how this goes through. But then as law stands now, what it is, we need to comply, and then wherever we see that the guarantee has been extended and it's a loan that is we have taken, and there is a charge out for the fee for the guarantee as well as the interest on this, it will all get cumulatively considered. That is the position.
Anyway, it is a guarantee for party loans.
Guarantee for?
Party loans from the.
That is no question. That will have to be reported. That will have to be reported and have to fall within this, because that becomes non-resident.
Indian banks.
So this is an example of what happens if you were to pick from SBI and HSBC India. So probably, so when it comes to HSBC India branch being a non-resident, 94B will be applicable, because their residential status is a non-residential branch of a foreign bank. Okay, so I mean it's a call that you are taking. It's a call that you are taking, and you have to be be able to defend it. And if that is the consistent position, then probably you should be able to at least get this to a tribunal level, if not lower. So one thing keeping in mind
What
that
happens to the indirect guarantee? For example, I sit in US, I guarantee to Citibank. Citibank guarantees State Bank of India, State Bank of India guarantees Chennai, and Chennai gives the loan.
No, I think you go back to the origin. If but for the group, the Citibank wouldn't have budged as to why will they volunteer to give guarantee to any other Indian bank. So indirect guarantee will definitely come in, direct or indirect. And that's why they say implicit or explicit. I think there is some usage of that language. So going by that, letter of comfort. If letter of comfort also is considered as a letter of a guarantee, then even indirect will fall in that. So this we dealt with, and the institute guidance clearly holds out that final audited standalone accounts of the company should be considered. So rather than getting into other interpretations, it comes straight from the standalone audited financials. So loss situation I have got here, loss, EBITDA. So I think this should explain, ma'am. So here you see EBITDA is 200, EBITDA is 200 negative, 30% is nil, total interest is 100, interest paid to AE is 100. So all of the interest is to AE, okay. Interest disallowed, the whole of it is disallowed, 100. Goes into next year they become profitable. Fortunately they have made 500 and 150 is the cap. So interesting observation. So which interest you will set off in the second year? You have interest paid to AE as well as 100, the entire interest of paid in the last year. So how would you kind of set it off?
Carry forward.
In the subsequent year, yeah. So whatever last year. Correct. Exactly. So because you have 8-year limit, first you exhaust the last year. Exhaust the last year and then take the current years for the next 8 year.
This is a worst provision. If they come up with like this for startups, it's a one case. First of all, I have an initial stage on top of it, I have to pay
Yes.
tax and the interest also.
This is where it hurts.
Don't borrow.
Don't borrow.
Don't borrow.
So think capitalization comes in another aspect. A startup company, the entrepreneur who starts, he has got great ideas. So he wants to be shared to be valued at 1,000 rupees. The person who puts the money, he runs a risk. But he has got an idea that it may. So you want to give it as a loan. He is satisfied with the interest. So how do you solve this problem? You cannot solve it. No?
No, that's fair. No? So if it is a PE investor or a venture capital who comes in as an investor vis-a-vis associated enterprise, that would be a difference. So for a startup, the investors probably would be those who want to capitalize on the idea and kind of take it big as and when it gets commercialized. So if it is a PE investor, he may not have an A relation as with them. So to that extent, what you kind of pay out in whatever form the funding is structured, that may not get disallowed because they are not your associated enterprise. But then when it comes from associated enterprise, to keep their skin in the game, because a lot of service companies we see that are very thinly capitalized. See the capital, paid up capital is 1 lakh, reserves is like 20 crores. So I think that's, and still you have debt and still you have interest despite these reserves. So I think we have seen all combinations, but I think the intent, but then indirectly it comes to hurt companies like the Gamesa which have gone and filed the writ, and their huge capital investment is needed and they have exhausted all options, and the group again depends whether it's already on the verge of bankrupt or how it is, but then it puts undue stress on them, and when this comes as a disallowance, it will go wasted. It may not even get set up over 8 years.
8 years.
So, okay, just last to kind of conclude, we have in various other countries in what forms it has taken. UK. So again, most of them have gone with this fixed ratio, 30%, 25%, 30%, and all of it. So this is, we have just attached it for reference that almost India is the 16th among all these countries that the regulations have kicked in now. So I think this time around when we are taking up the tax audits in the new format, we should be comfortable to deal with this, is my belief now. I think certainly this material is something that should get shared with you as a referencer, and you have has the Institute implementation guideline also there to help you, and I think we have given as much examples. If you are fine, we can move to the next topic. Any more clarifications needed? So it's not that one thing that you can say that it's going to kind of impact across. So we have to see, I mean, who all fall into the trap, and then where they don't really have any other option, then probably some legal course has to be taken up. That because this clearly discriminates and kind of will them have them out of play.
How about CCDs now?
They will be financial instruments. Yes. So who deals with transfer pricing, as in either from you are from corporate or okay you do okay. So because this is something, I mean now practically almost everyone, while in practice or whether in your own companies, there will be some element, either you would have gone outbound or you might be a subsidiary of a multinational. So transfer pricing is something you would have come across by now, I mean as in practically. So what has been happening in the Indian context, we have seen through over the years, over the last almost close to about 17-18 years, okay, since the time the regulations came into India. What the way that it had got administered was every other case got scrutinized, everyone was looked at as to what is the profitability. It all became a play of profitability. Are you profitable or not? Then what is the comparables? Okay, even if there are 2-3 companies which are making high margins, that will be in the comparable, and then you will always be found to be lesser than the comparable average, and there used to be an adjustment. So that adjustment, what the transfer pricing officer, based on the transfer pricing audit of the documentation he makes, is primary adjustment. Primary is what he will say, you have paid more, or you should have collected more, you have sold, you have undersold, or you have paid more for what you have purchased, or he will disallow management fees. Like morning you would have heard what challenges we have in getting management fees across, or royalty or technical fee, everything to do with AE. Every nature of transaction would have come under the scanner, but largely it would have got camouflaged under the margin, saying that okay, you are no good, your margin is less, probably this is not, and even for services the margins they are expecting is quite high, 25% upward. So that's not the way companies are here to do businesses. They believe that even a 10 is a good amount of return, looking into their own countries, 10 giving 10 to India for the kind of work that happens. But again, some companies have been aggressive to do several of the high-end work that is there, that goes directly into the product of the company itself to be compensated at a 10% or a 12%. So which is again not fair. So short point is, till now we have seen days of primary adjustments largely. There used to be some kind of an adjustment which we saw and which were huge, as in like in Shell, there was some 15,000 crores adjusted on one company, and then a secondary adjustment of while recharacterizing this, the premium as advance or some kind of a debt and having an interest imputation. We have seen that in Vodafone. The numbers were just mind-boggling. To top up the primary adjustment, there was recharacterization of the amount of the capital that has come in, either if it is a premium. The debate used to be like, you have issued at a higher price, you should not have been so. This is actually a loan that you have given in the guard, you should get interest back. And then there is 1,000, like Hindalco has 1,100 crores of addition on interest. Primary adjustment is the first level of adjustment. Then, so as we discussed, either you will get disallowed that you have paid more or you have collected less. The differential takes the character. So till now the primary adjustments, how it used to be dealt is, fine, the HSE will accept at some level of stage, either at an tax or somewhere, that yes, finally this remains, and tax on that is discharged. But nobody really bothered to get in the remittance for that. Nobody really bothered to make accounting entries as advance having given earlier and lying with the group. I have paid more and it's an advance, or it is something that I have paid short, which is again on the sales. Okay, it comes to sales that I have collected less, so it is an advance that's remaining. So nobody treaded, other than this share related issue of secondary adjustment coming in, we didn't see secondary adjustment. The law did not enable applying secondary adjustments and interest imputation on that. So what we saw in case of Vodafone, and finally you saw that the Ministry of Finance and in the cabinet, the Union cabinet, it was said that they are not going to pursue this matter further before the Supreme Court, and it attained finality in the Bombay High Court that the secondary adjustment is something that cannot be done. So it came up that the TP provisions may merit a transaction to be re-quantified but not re-characterized. Re-quantified, so only on the re-quantified amount you have to offer it and pay tax. There is nothing that is dealt till now as bring in remittance, you have to get in, and if you don't get, it will change the character of what you have paid surplus. It will change as something that's given as advance, and that will have to be an interest on that if it is more than a particular period of time. So in sum and substance, secondary adjustment has been brought into the law, and that is where now technically there are 5 instances, like we will go through it, when you will offer for the return, or you will probably accept after a level of litigation with the revenue, or in an advance pricing agreement you will conclude for 5 years that probably I was making 15 but I should have made 17 or 18 and conclude an EPA. Then what would happen for all those years where you have under invoiced or where the markup is not adequate as what you have agreed and concluded finally? So by a secondary adjustment, you are expected to bring in the remittance within 90 days of the due date. Under each parameter, the due date varies. We will get to that. So within 90 days, you have to bring it. If not, then it becomes advance in the hands of the associated enterprise. And then there is an interest. So if it is a foreign currency, then there is a particular benchmark. If it is an Indian loan, then there is as an Indian advance, then there is Indian currency, then there is a particular rate. All this is being brought into the law. So what was earlier contested as the law does not enable recharacterization, does not enable levy of secondary adjustment, is now brought into the law and enforceable. So concept you have understood?
So we need to pass the everything, we have to increase the sales by 200 rupees.
Yeah. But the thing is, when it gets into litigation, you have always been on the receiving end. If you say 200, they will say 400. If you say 400, they will say 10. So where is the... So as long as you have maintained a documentation, as long as you have a benchmarking and complied with across, and there is a methodology to justify that, then at least if not at a DRP, you probably would have got at a tribunal. If you have made a 15%, you can always feel rest assured that at least a tribunal will be able to bless based on, no. But then, so what form it can take? What form the surplus that gets disallowed? So let's first look into where will these cases come in, as in when will it apply. Introduction to 92 CE. Finance Act 2017 introduced the concept of secondary adjustment by way of insertion of section 92 CE of the Act. Secondary adjustment means an adjustment in the books of accounts of the assessee and its AE to reflect that the actual allocation of profits between the assessee and its associated enterprise are consistent with the transfer price. It's not alone in spirit, it is also in form, sum and substance. Okay. So that's what it means. Determined as a result of okay, let me read it from the beginning. Secondary adjustment means an adjustment in the books of account of the assessee and its AE to reflect that the actual allocation of the profits between the assessee and its AE are consistent with the transfer price, determined as a result of primary adjustment, thereby removing the imbalance between cash account and actual profit of the assessee. So if they don't bring in the money, or if they don't characterize this as advance, the asset base is eroded. So generally when you say base erosion, we try and relate with cost base. This is where actually the asset base erosion happens. Either you don't receive money into your bank. So in India, your bank account doesn't receive the money for what you should have otherwise got, or you don't report it as receivable from the group. You don't even show it in your books as advance. So it is more from the context of curbing asset base erosion. This secondary adjustment has been brought in to ensure that in sum and substance you comply with transfer price, arm's length. It is not alone that you offer additionally pay tax and then move away. Make an entry in the book. So should we move to the entry, or should we again dwell on the concept? I mean, because I went into asset base erosion, probably let's look at the entry. Okay, so let's look at this example. So far so good, you are able to understand, the base is fine. Okay. So situation A, situation B. US parent company, India company, Indian company purchases goods from its US parent. Okay. The Indian company is able to do an end sale of 120, purchase from US by paying a transfer price of 100. The net profit it pockets is 20. Arm's length price, the transfer price and the arm's length price in situation A is the same. Okay, understood? No primary adjustment. My transfer price is right, I have recommended it as ALP. The TPO also is satisfied. No primary adjustment. Situation B, primary adjustment by the TPO. The TPO now comes to clear the spoil spot. He says, so here you have transfer price at 115. Okay, basically the Indian company has paid out more. Probably they believe the value is 115. The transfer price from Indian company. Indian company purchases goods from US. Okay, and sells at 120. Both the cases. In the first case, they paid to US 100 and established that that's the ALP. Second place, there was more tough TPO. He said, like the second case, basically what they did was, the transfer price was 115. They tried to probably kind of see that the parent is compensated more and they are paid for higher, okay, 115. So the TPO now says, no, this has also to be at 100. I don't accept a higher price. This is the time the TPO has made an adjustment of 15, as in primary adjustment of 15 million. So 115 minus 100 is the primary adjustment.
Payable.
No?
Company is making the payment. So payment adjustment TPO will do. It will reduce the profits for India. Why will TPO do this adjustment? Why will TPO do this adjustment?
No. India is selling at 120. purchasing at 115, which the TPO says you should not purchase at 115, you should purchase at 100. He's pushed down the cost of purchase. Profit increases. Okay, understood? So primary adjustment is 15. So in situation D above, the tax authorities will add 15 million to the taxable income of taxpayer towards overpaid purchase price and recover tax thereon. However, as per the current scheme of things, even after affecting the adjustment and collecting tax thereon, the net profit of taxpayer would still be lower by an amount of 15 million and liabilities would be overstated by a similar amount. This is clear? We don't bring in money, we don't even go back to say that it was lying with them as advance. So, in the example provided in the previous slide, suppose the adjustment is accepted by the taxpayer, the excess transfer price of 15 million needs to be repatriated back to India within the prescribed time. Situation A, the excess money is brought back. They agree, okay, no, I think we should comply in spirit and form. Let's pay back to India what is being decided by the transfer pricing officer, and they say that you have paid us more earlier, you paid us 15 more, your TPO said 100, so we will pay you back. So India will receive in its bank account, okay, bank account, P&L, and the above entry will have twofold impact. The net profit would increase by 15 million because they have paid me back, it's a return, and the asset base which previously stood eroded would be recouped by a similar amount. Understood? Now they decide that we don't have cash crunch, we will, when we get funds we will see, we will limit, but for now you carry it forward, we can't pay. The excess money is not brought back to India within the prescribed time. Then record it in the book as advance time with them. Show that as an asset, advance to AE, to P&L, 15 million. The above entry will have the following implication. The net profit would increase by 15. Similar amount would be added to the asset base of the taxpayer, which is the Indian company. And after it is advanced, there has to be an interest. So, calculate interest. So here, just let me jump to interest, the recommended interest, so that we will have a. So slide 40. I mean, as in, sorry, it may not relate with what you have. The Indian national rupee. So if it is an Indian denominated, rupee denominated currency transaction, 1 year marginal cost of funds lending rate, MCLR, of State Bank of India as on 1st April of the relevant previous year plus 325 basis points. This should probably come to around, say, around more than 10% or more than that. Foreign currency, 6-month LIBOR. 6-month LIBOR as on today is about 2.5. So as on 30th September of relevant previous year in the relevant foreign currency plus 300. So 2.5 plus 3, 5.5. Foreign currency 5.5% interest, Indian currency close to 10%. Will be imputed for the period. So that for the period from when, now we have to understand. So in what situations it will arise, and this is the interest based on the currency, but up to when? When does this crystallize? Does it get crystallized after they say even after 90 days that we won't pay you, or does it crystallize right from the time the primary adjustment has been made? So let's go back to 5 instances when primary adjustment is triggered, accepted. So by the due date prescribed, so when it has to be repatriated back. A secondary adjustment shall be made only in case of below mentioned primary adjustments after 90 days of the due date. So what I have seen in practice earlier, the taxpayer or the client follows his approach 10%, and then when he goes for audit, the auditor probably says, hey, 10% is not going to sail through, you should at least report 30 or 50. So they will report in the return, not in the books. They will pay tax and they have done outside of the books adjustment in the return. The law itself contains the provision to make an outside. Okay, then they say, okay fine, forget all this. Even now you will not be able to avoid the chance of an scrutiny, but if you go for safe harbor, you just get the safe harbor rate. You need not remit it at 17%, 22%, or whatever as applies to you under the safe harbor. Just pay, charge tax on that, on whatever your cost is. you don't have to get probably, so you may continue to get a remittance at 10% and then pay tax on 17% just to be in safe harbor. Safe harbor, if you comply, then really you are not scrutinized as much because you are anyway paying more than arm's length. So as far as tax is discharged at more than arm's length percentage, then you are not under the scanner to safe harbor. So in a safe harbor situation, when that kind of a scenario happens, then there is this instance a trigger of secondary adjustment can happen because you have not brought in the remittance for the value of service that you have delivered. The value is like measured based on safe harbor at 17, or currently at 17, earlier was more. So that is another instance. Then there are instances where companies have gone for APA or where they are litigating before tribunal, and some stage it gets accepted and he believes there is no further objective to pursue this litigation to high court, and revenue also kind of gets satisfied with whatever it is done. So there is a finality achieved on accepting what is adjusted. That time again this fructifies. So there are 5 instances: suo motu adjustment in the return, acceptance of adjustment made by the assessing officer, which can be even up to the ITAT, various appeal stage, determination in an APA, adoption of safe harbor, resolution under MAP. Is this clear? Under what instances this can get triggered? That you accept a primary adjustment. The follow through of secondary will come in now. Proviso to section 92CE1. No secondary. Okay. Let's understand when it would apply that 1 crore monetary threshold. 1 crore, I don't know why the government is believes still 1 crore is a big sum of money, which easily this threshold will, I think again most of the thresholds given in the tax laws become redundant by the time they have brought in itself. So if the primary adjustment is made in respect of assessment year commencing on or before first day of April 16. Secondary adjustment introduced where primary adjustment resulting increase in total income or reduction in loss. That is why the primary adjustment happens. Either it leads to increase in income or reduction in loss. Excess money available with AG as a result of primary adjustment, if not repatriated to India within the prescribed time, to be treated as an interest-bearing advance. So recharacterization is what is being paid more, or what is received short takes the character of advance. That is the recharacterization. Recharacterization has been enabled through this provision, and that is the secondary adjustment. Interest is the consequential impact of the secondary adjustment. The secondary adjustment first came into place because you are not accepting the primary adjustment by actually kind of paying it off. So the secondary adjustment forces you to record it as an advance beyond 90-day limit. Once you record it as advance, it becomes a kind of, it falls within the definition of capital finance. So we should have an interest element. Interest is recommended what it is. Clear?
So but you said it can be re-quantified but not really.
That is the law kind of got concluded after enormous litigation on those huge litigative issues. Finally, it went to the stage that in the way the law is, before section 92CE came in, there was no other provision under the income tax law to say that the over and above was advance and all those things. Now it has been brought in. Now secondary adjustment itself is defined to say if money doesn't come in, then it becomes
Advance.
yes. Yes.
So the due date is 30th
Due date is no. So let's.
section 129
You are talking about
This due date prescribed, due date filing return under section 129
Yeah. So we'll go back to that. We'll go back to that with the examples. Okay. So I just wanted to say
5 examples.
okay. So here just an observation as to when it will click in. Okay. The Finance Act 2017, the said provision shall apply from assessment year 1890. Actually, they got the year wrong. The CBDT-wide press release dated June 19, 2017 has clarified that the time limit of 90 days for repatriation of excess money shall begin only when the primary adjustment exceeding 1 crore. So always have this 1 crore in mind. If it is less than 1 crore, don't even look at these things. Made in respect of assessment year 17, 18 or later. Okay. Secondary adjustment can be imposed for any primary adjustment made with respect to financial year 15. no secondary adjustment, sorry, I missed the no. So secondary adjustment cannot be applied for any primary adjustment made relating to financial year 15 and 16 or any other earlier years. So it starts from financial year 16-17. Okay, so understood. So 16-17 is the first base year. No, 16-17 is the base year for which what happens technically, the secondary adjustment. So by November 30th, so let's kind of explain to you through this example.
So 90 days from November 30th.
Correct. 90 days from November 30th, which will be say February 28th. Okay. Then that secondary adjustment and the interest component becomes an income into that year. So when we say 16-17, it becomes 17-18. So for 17-18, this will get assessed and get offered, and it would be assumed that you should have received an interest for what you have left as advance with them. I'm just trying to give this example, probably just to kind of make it clear on the year. Primary adjustment of 6%. So in this fact, provision of marketing support service at cost less 10. So they all felt like others that 10% is good enough return for market support, which is actually, but then unfortunately this got determined at 16%. Even probably the cost base is not much, they agreed saying okay fine, 10 has moved to 16, let's agree to disagree but still pay out this out. So now with all this ramification, the primary adjustment, there is a primary adjustment of 6% incremental return. And so this comes in financial year 17-18. So they realize that by the time they go and file the return, November 18, this primary adjustment triggers in. So they need to receive the remittance by February 2019. You understood? November 18, 90 days, February. So money comes in. Yes, no secondary adjustment, no essay. Money has come in, done. But money doesn't come in. Secondary adjustment for 18-19. Interest is imputed from November 2018. The due date of filing the return is 30th November.
This is using financial year 18-19.
Huh.
But
We go to the next year, as in money doesn't come in, the year goes into the next year. So in my financials of 18-19, interest is imputed from 30th November 18 because by February 19 I have not got it. So for March 19, which is this FY 18-19, in my financials 18-19, secondary adjustment and consequential interest is recognized. So reported in the books as deemed advance. Okay, the fallout of it is I acknowledge it as advance in my books. Interest imputed from November 18 to March 31-19. Interest income affected in tax and written off income for 18-19. 18-19, for that financial year, I offer the interest at the rate as determined calculate. So that implication comes in financial year 18-19. And then subsequent year, I assume carry. So again, interest again, if you don't receive interest, then that will also get subsumed into advance. So the worst thing is they have not put a cap. So this can keep going on indefinite. So that's where this explanation, this illustration.
Secondary adjustment also will need to pass away because this secondary adjustment applies from April 17-18. So March 18 return which will be filing now, this will also be impacted.
Yes. So if you don't receive the money in Feb 19, it will impact into this year 18-19, not 17-18. 17-18, you see that there is a primary adjustment. Okay. That means that within 90 days of November 30th, you need to get that money in the differential. If you don't get, then you will actually record that advance entry in the financial year 18-19. Not the earlier year. Earlier year you have closed, you have filed the return. In the return you offered it, but money you did not get. Money.
This is applicable from April 17-18 it says. They say secondary adjustment from the last year that what we are closing now, the financial year ended March 18. This year also this entry will come in.
This year, whether so March 18 entry can't come in because it is going into February 2019 to establish establish the fact that money has not come in. So it has to be in the financial year 18-19 when the entry will come in. But it is coming, arising as a result of the primary adjustment of 17-18. Understood? No, madam is confused. No.
So you are looking for the financial year,
Looking for the financial year.
If I go one step back, because it says secondary adjustment starts from July 17-18. If you look at March 17 here, because March 17 I will have to do the accounting in March 18.
So in this, you are talking in the context of this illustration 17-18. I mean, as an arm's length markup of 16%, arm's length markup of 16% determined by taxpayer for 17-18 at the time of filing of return of income. The return of income, when is it filed for 18? November 18. If you are a TP case, November 18. Okay. Within 90 days of 30th November, will you get the money? If you get the money, no question of secondary adjustment. If you don't get the money by February 28, 2019, for the fiscal 18-19, because money did not come in, it takes the character of secondary adjustment, becomes an advance. That advance has to be, you have to pass the entry in the financial year 18-19. Okay. So that's where, I mean, this is how you would go, but I wanted to put a question that would you go back and file a revised return for 17-18, because ideally not, because 17-18, if you were to receive money, why will you even have a secondary adjustment? So we can't hypothecate that I am not going to receive money and do that until the event happens. The event is happening in February 19, that ultimately March 1st you realize money has not come in. You understand?
In the next year, say 1920, also the money doesn't come in.
Yeah, money doesn't come in. It will keep.
The whole year will keep
Yes, that's what will happen. So you are compelled to bring in cash or whatever money.
What happens if the other countries they decide that you should not have
So
it's not 115 rupees, if you have sold it at 120 rupees, so you get back 55 rupees more, you are shifting profit, then what happens?
Yes, you are right. So that's why we are saying whether Indian authorities have right to seek such adjustment in the books of AE, the same being outside of the jurisdiction, issue for discussion. So you can't arm twist them under IFRS or whatever accounting standards of that country to recognize.
Other countries' tax authorities say that you have shifted profit to a low tax regime. US is a higher tax, so you have sold it at 150, you should have sold at 120, get back 5 rupees from them. So what will happen then?
You are saying that is there something in the law, secondary adjustment is like what I get, I should also be able to give. So if other country challenges and who brings in a secondary adjustment, so they ask whether we would allow. So the whole thing, now let's fundamentally go back. It's a very good question that you have brought in. So there is something in the law called corroborating adjustments. Okay, I'm just trying to get that. Okay, let's look at it. Model tax convention. So all these things gets governed by treaty provisions. Model tax convention. Okay, under the model tax convention of the OECD, to avoid double taxation with respect to the primary adjustment, once it is accepted under the treaty provisions. So if it is a MAP conclusion, if it is a bilateral APA, okay, the country, the competent authorities agree, sign off saying if 18% is accepted there, then 18% should be tax allowable here. Otherwise, it is a situation of double taxation. What we call as corroborative or corresponding adjustment. Okay, it is built into Article 9(2) of the Model Treaty Convention. It is there in every other country treaties with India. So if there is an enabler, then using this article, we can get a corresponding adjustment for the primary adjustment, but none of them give a corroborative adjustment or corresponding adjustment with respect to secondary adjustment. So all the countries where there is a secondary adjustment, it results in double taxation. Tax in your jurisdiction on bringing in that, but they are not going to get it as tax deductible. 92 CE, first point, leads to double taxation. So you have identified the devil in the whatever. So yes, it leads into double taxation. So there is no way out of it. So you have to live with it. So that's what. So I mean the way each of these regulations, while you are saying that, see, all of it is about trying to bring consistency and the same language all countries in the jurisdictions talk, so that everyone can come above board and everyone is transparent with the other. So like your whole of the C by C and your 3-tier documentation and all of this, some of the things like this thin capitalization, secondary adjustments have again drawn the Indian tax the implications more worse off than anything better. So thin capitalization, if it is a loss, then you can't really take debt from the AE and then it will be an indefinite disallowance. And secondary adjustment will be doubly taxed. So somehow or other getting the money. It is, while as much we say that investors have taken all that, but then the government is taking as much to see that its cost base, asset base, everything is protected and they are able to garner as much revenue at any given opportunity. If it is not there in the law, if they have decided not to fight it out of the Supreme Court, within 2 years change the law and bring it into the law to say that it can be recharacterized as well as in the case of your secondary adjustment. So these are the things which have come out as development, and really it was a surprise to get this to be reported in the tax audit report. That was like nailing it. So
Rate of interest, what you are
rate of interest on which one? On rate of interest, so I told bifurcated between Indian currency and foreign currency. And it is like state banks. Earlier it used to be base rate, now it is changed to marginal cost of funds. Marginal cost of funds means whatever rate that I am offering for every new loan that is being taken. So it will be definitely, it will go with the trend what is being, okay. And your foreign currency is LIBOR, 6-month LIBOR. 6-month LIBOR is about 2.5% now. So with 300 additional 300 basis points, about 5.5. 5.5 for foreign loan and about close to 10 for Indian currency. It will start from beginning. 90 days is the safe harbor for you to arrange and get it. If you don't get it, it will start from due date. See, I think we need some buying from the auditors as well. But then, this is where we dealt it in that example. So when we receive bank to P&L and advance to me, so we have to park it in some reserve or what. I mean, yeah. So
it will not lead to revenue, not to pass to P&L. That
yeah, reserves, that's what. P&L is like, that's what I said. You call it by some name as some reserve and park it. I mean, as you can't.
But then how does it lead to double taxation? So because they are paying you the money, right? So
And they are not getting, it is an expense for them, right? They are paying you more than what it is. So it is doubly taxed, as in here you are offering to tax and there they are not getting it as a deduction. You understand?
This year, this secondary adjustment, that will affect in 3 cities. So I think you say November. We are now what we are filing. Right now some companies file.
No, so that is addressed. Yes. If there is any,
some companies file now. Next year.
So listen to this. So it's on page 24. If the adjustment relates to an assessment year prior to assessment year 17-18, or the primary adjustment is less than 1 crore, the excess money is not required to be repatriated to India, and the answer to this question may be given as no. The answer to this question should be given as yes only only if the adjustment relates to assessment year 17, 18 or later assessment years, and if the adjustment takes 6 months old.
17, 18,
So-
we will do now. That is important from this year. Next year is
Yeah. If you don't bring it, it's a violation. You should bring it ideally. I mean, till now we have got away by not bringing it. Huh?
Water company, okay, if they are paid the taxes, they are not ready to pay the amount. What will do? Pay the tax, it's only for tax purpose, right?
It is only for tax purpose. But it will indefinitely keep on accumulating.
Only for tax purpose.
If you take that call, you can be happy and you can continue to pay in the offer that interest, and the interest also will get compounded, and that's how it would be calculated. So if you say that fine, I am ready to continue to live with it, then you can keep accruing in the books as advance, and then the interest on it keep offering for tax. You can take that position.
Memo point of view, they are not right. Because they emotionally we are creating it. Not actually it's memo point of view.
No, what was notionally earlier, they are saying that you bring in accountability by recording it in the books as receivable from them. So,
Memo point of view. That means memo.
yeah, I mean,
Memo they will also say.
They will.
Yeah.
they will. So again, some conflicts we have got, like 222E was already there. It says that any amount lying with them is an advance. So as in 222E will require this to be a dividend, and then you will have 92C requiring it to be a advance. So kind of we have to see how this would be interpreted. And there are probably in 222E it should carve out an exception to the advance that is brought out under 92C. Otherwise there is an overlap. Like one section says any advance line will partake the character of dividend, and here you say under 92C that anything established and the primary adjustment doesn't come in, then it's an advance, which means like it becomes an advance, and because it's an advance it becomes a dividend. So you can't have both. So I think so much so if you are, I think we are at 1:30. So if you believe you have got enough clarity on this and you are confident, we can proceed for the lunch, or you can always approach my phone number is there and this will get circulated. I will ensure that. But given that this we discussed in as much detail, I would probably suggest that you spend some time to get yourself acquainted to these, and when you look into the financials, with the audited financials of the clients, it gives a different kind of surmise to things. So probably it's worth spending that time, given this reporting requirement is coming, and at the end of the day we sign off these tax audit reports. And thanks for this patient hearing and coming up with these questions. I hope I have kept you as much engaged and that I was learning through this session. Thank you.